Afternoon guys, hope you're all well. So today's stream I'm going to talk a bit about something we at Futex don't really focus on too much, but has been very much a key driver of global markets over the last couple of weeks, and that's the oil market. I don't trade oil, never have done, but it could well continue to lead the markets over the coming weeks, so I think it's important to be aware of what's going on and how it can impact the markets. I'll first start by looking at what the market has done over the last little while, before then maybe touching on some of the economics of how oil prices can feed into the wider economy, and then I'll finish by going through how the oil markets can impact on the core markets we trade here at Futex, so the bonds, the currencies, the equities, and so on. So basically ever since the 70s, oil has been a major driver of the world economy. It shouldn't really surprise, given oil is the basic energy source for much of today's, I guess, economic prosperity and wealth. But in the last, 4 to 5 months or so, it's very much come back in vogue, and in the last month it's really moved quite aggressively. So until the summer, as basically this chart shows Brent prices, Brent oil over the last 5 years, so from 2009 onwards to today. So until the summer, for the last 4 years pretty much, we've been in this kind of $95 to $120 range, so pretty tight over the last four or 5 years. Recently, however, the benchmark Brent price has dropped about 40% since June of this year to where we are now. So we're nearly at 5-year lows. Like I said, fallen 40% from June, and I think November, this bar here was 18% alone. So pretty big and substantial moves given what we've seen in the 4 to 5 years prior. So why has this happened? It's come about basically due to 3 main factors. 1 being weak demand, 2 being a strong US dollar, and 3 a surge in oil supply basically. On the demand side, it's primarily been because of the stagnant economy in Europe and also a slowdown of the Chinese economy. And China generally accounts for about 1/3 of the world's oil demand. So overall, although overall demand is slowing, it appears to me though the bigger factor is more about supply, and in particular the unprecedented increase in shale oil production that we have seen in the US. At last Thursday's OPEC meeting, there was some talk about production being cut in order to stop the slide in oil prices, but when Saudi Arabia blocked calls for this, block calls for production to be cut, oil prices slid even further. It's fallen another 10% since last Thursday's OPEC meeting, and seems like not everyone is overly happy about it. It may seem a strange decision to be made at the OPEC meeting given the drop in oil, but as US shale oil becomes as oil prices dip, the US shale becomes less economical to produce. So if oil prices are allowed to remain low for some time, it could actually cap shale production over the longer term. So keeping low oil prices may in fact make sense for OPEC. If they kept prices low for long enough, it essentially has the aim of driving some of these higher cost oil producers out of the market, so OPEC essentially and Saudi Arabia in particular are trying to drive these competitors out to get market share, to maintain the market share for the long run, and probably drive up oil prices in the future. But like I said, not everyone has been totally happy with this, even within OPEC. And this will be shown by this little graphic I'm going to bring up now. So the fall in oil prices has been a problem for a lot of these countries, because a lot of these countries within OPEC require a price above $80 a barrel to balance their government and budget deficits. And as you can see, Iraq requires over $100 million a barrel oil price, Libya 184, Venezuela and Nigeria 120-ish, and even Saudi Arabia, they in the longer term they require this. So although in general falling oil prices is bad news for the biggest exporting countries, as can be seen by this. It's aimed, the low oil price and output not being cut back is aimed at wiping these US producers out of the market. So while Saudi Arabia also needs a higher oil price than where we're currently at, it in essence is willing to forego this in the short term to get higher prices and market share in the longer term. So that's a little bit of the context of how oil has come down, where it's come down, what the issues are for OPEC nations. The likes of Nigeria and Venezuela were not very happy at Thursday's OPEC meeting because, look, they need a higher oil price, and it's more important to them because I guess the likes of Saudi Arabia and the UAE have deep pockets and can wear this short-term fall in oil price. For the likes of Venezuela, Nigeria, Libya, they don't have the same sort of reserves and same balance sheet. So even within OPEC, there's a bit of wrangling, but Saudi Arabia by far, I guess, rules the roost in that respect. So how does oil impact the global economy? So it can be viewed in many different ways. Usually falling oil prices would be welcomed by the big oil consuming regions, so America, Europe and Asia. But the fact that part of the fall in oil is largely a reflection of weak global demand amidst like a low growth environment means the picture is a little bit clouded. Oil price falls can be both deflationary and inflationary at the same time, which I guess is a bit of a strange mix when you come to think of it. If the price goes too low, it will boost the economy in the longer term, while simultaneously lowering inflation in the short term. Why does it do that? Well, a fall in oil prices is effectively like a free tax cut to oil-consuming regions. In theory, the fall in oil prices could lead to higher spending on other goods and services, and I guess add to economic growth and GDP in general. So, a fall in oil prices, the dynamic is it brings down prices, thereby increasing real wages. I mean, we feel it, say, at the petrol pumps. So for any of you that drive or have cars, we'll see that petrol prices have been going lower recently. But I mean, aside from that, it gradually feeds through the production and distribution chains. All energy becomes cheaper, fertilizer becomes cheaper, food becomes cheaper, holidays become cheaper, and so on. So we get a higher living standard, but more as a result of lower prices than larger incomes. So a problem for many central banks at the moment has been stagnant real wages. But I guess the lowering energy prices, the lowering oil prices, means this fall in the cost of living is important in giving consumers more money to spend. Even though actual wages aren't increasing, there's more disposable income because of this. So I guess if we look at a few countries, in the UK and the US, there's kind of already some evidence that lower fuel prices are helping to boost consumer spending and confidence, as data has shown. In Europe and Japan, however, it's a different story, given the deflation and low consumer confidence that's present in those regions. Any fall in oil price that the consumer sees and any additional disposable income they have as a result of it, they're unlikely to spend but prefer to save, just given what the situation is in Europe and Japan. So falling oil prices, rather than helping increase spending, it can actually push down inflation and make deflation, I guess, a possibility. And for Europe, you know, we all focus on the ECB here, we all focus on Draghi here, and it's bad news for them because for Draghi, this lower inflation these lower oil prices, will prevent any, I guess, rebound in inflation. In Europe, policymakers are struggling with deflation, and lower oil prices will only make the ECB's challenge even harder as it loosens monetary policy to try and raise consumer prices. So, you know, we have ECB meeting this week, and I think the fall in oil prices will be definitely questions will be asked to Draghi how he sees it. I'm pretty sure about that. So it's not just Europe. It's in Japan. It's exactly the same thing. You know, it's a mixed blessing for them. Japan imports nearly all of its oil that it uses. So in the longer term, they'll get benefits from it, but in the short term, lower prices, lower inflation, and Japan have really been stuck in, I guess, a deflationary rut for a good 15, 20 years now. Finally, one more country, China. It's the largest net importer of oil, and again, China should gain from falling oil prices, but however, lower oil prices won't fully offset, I guess, the wider effects of a slowing economy. So that's a bit of economic spiel. I guess I did an economics degree, but just putting it into context of how low oil prices can affect the consumer and the macroeconomics of a country. So I guess what we're most concerned with here at Futex is, you know, the trading side of it and how it affects the markets we trade. Like I said, over the last couple of weeks, we've seen the oil market really drive global markets in general, and I think, guys, it's really important that we're aware of this stuff that I've just talked about, the context of the oil market, the drivers of the oil market, how it feeds into the broader economy, how it feeds into inflation, how it feeds into growth, and so on. So in equity space, following OPEC's meeting on Thursday, indices were sold very heavily following the OPEC meeting. European and gas stocks, I think, dropped around 5% and led the slide down. In general, equities have been going down with low oil prices, but given the positive impacts it can have on business costs and consumer spending in the longer run, it's not a guaranteed this relationship will continue. For now, though, it does seem like weak oil market is leading to a weak equity market. But again, you know, you've got to be flexible. You've got to be able to adapt. What the market believe now may not be what the market believe later. But for the time being, it does seem that the equity markets don't like the oil price down here. Moving on into currency space, that following the OPEC meeting on Thursday, the safe haven dollar has strengthened against pretty much all currencies, especially against commodity-related currencies, but also the euro and the yen following the OPEC meeting. As I mentioned a couple of minutes ago, although a lower oil price helps to support economic growth, it can undermine attempts in Japan and the Eurozone to avoid deflation. So following the OPEC meeting, the dollar rose around 0.5% against the yen, around 0.25% against the euro. But I guess the more dramatic moves in the dollar were against the currencies, the commodity currencies. So I mean, something like the Norwegian kroner, for example, is at 5-year highs. The dollar is at 5-year highs against that currency. So I'm just going to bring up a chart actually, which I think is quite useful and interesting to look at. So often large moves in commodities will have strong correlations with the US dollar, primarily because commodities are priced in US dollars, and in effect the dollar will move to negate some of the commodity price movements. And we've seen this on big commodity movements. And this chart here, what it shows, that the orange line shows Brent crude, and the red line shows the dollar basket. So, you know, it's a weighted basket. The dollar index is a weighted basket against 6 or 7 currencies. The euro is about 60% of it, and there are some other currencies in there. But what we've seen in this, I guess, the last 6 months, is this move down in oil here from, I guess, $110 a barrel to 65 or just over $65 a barrel has been synonymous with a rising dollar index. So the US dollar has strengthened. So, you know, why is that important? Well, it could provide trade opportunities. We see oil collapse, we really should see the dollar rally. So whether, and for guys who trade FX, it's about choosing the right currency pair to trade, depending on, I guess, what your view is on whether it's the euro, the pound, the yen, the Swissy, or whatever currency pair you have limits on. But you know, we've seen this in the last 6 months, but this isn't a one-off phenomenon. I mean, following the global financial crisis, same thing happened. You know, we got this huge move lower in oil prices from close to $150 a barrel down to $35 a barrel, and at the same time we saw the dollar index rise, and again here, as this is the opposite, as oil prices rose, the dollar index falls. So it's kind of, you don't always get this relationship, but when we see big moves or consistent moves, as we have on this spike down here in oil prices, as we did in this spike down here with oil prices, as we saw with this consistent rally in oil prices, the dollar does adjust. So that creates an opportunity, not only if you trade oil, but if you trade FX, there's an opportunity to trade on the back of oil price moves. Now, for 4 years, we were a pretty tight range with Brent crude, like I said, 95 to 120 range for a good 4 years, and the dollar index, well, didn't really do too much. So there's not always a trade there, but there generally is something to do when the market is moving and it's volatile. And this doesn't need to be related just to oil. Any commodities, you'll get this similar relationship. I mean, I've got the oil chart up, but you know, anything that is a dollar denominated commodity should behave in this way. So with regard to bonds, the relationship between oil and bonds isn't always clear, largely due to the fact that low oil prices could dampen inflation in the short term, but actually boost growth in the longer term. I already talked about the problems low oil prices pose for low inflation in Europe and Japan, but I guess what I found interesting yesterday was the comments of Fed's Fisher, who's the vice chairman on the FOMC. That's Fisher with a C, not the Fisher who spoke today. He basically said the recent drop in oil prices isn't bothering him too much, and he's not really thinking about it. He said the effects of a drag lower in energy prices on low inflation should be temporary. Temporary why? Just because you get this instant hit in prices in general, but in fact have a positive growth effect. Why? Again, as I mentioned previously, you get lower prices now, businesses can spend more, consumers can spend more in the future, and hopefully it will stoke up economic growth. And what was very clear yesterday is bond markets were very well bid yesterday until these comments come out, and then the bonds slid off, especially the T-note came off, the 5-year and the 10-year, and the Bund followed on the back of it. Okay, so I won't carry on for too long. I think I've gone on enough, but basically to sum up, oil has been impacting our markets quite significantly in recent sessions, and I think it's very, very important to keep abreast of what's going on and pay attention to this market, whether it be oil inventory data, key speeches or comments from OPEC members, or headlines from those with a vested interest in oil markets. I mean, different things will drive the markets at different times, guys, and it's very important that we're on top of it. At certain times it's Ukraine driving the markets, at certain times it's the peripherals driving the markets, at certain times it's EM currencies, at certain times it might be the banks, banking stocks, equity markets, it could be anything, Ebola. At different times different things are driving the markets, and it seems to me now oil is very much in vogue and is an important driver in the market. So even if you don't trade oil, it's important you know what's going on, because it's ultimately affecting the markets we trade here. So an awareness is essential. The markets are correlated, correlations do exist, correlations do change, relationships do change. But knowing what's going on in these markets could provide a good boost to your P&Ls through the product you trade. So opportunities will arise. So let's be prepared to act on any opportunities, like I said, from any comments from OPEC members, oil supply data, even comments from Putin. Russia is a huge producer of oil, so they could have impacts on the markets you trade, whether it be equities, FX, bonds, doesn't matter. Opportunities do arise and will arise, and this oil phenomenon is not going to go away anytime soon. So let's be prepared, and let's not leave any money on the table when there's something to do. Alright guys, I think I've gone on enough, as I said, and good luck for the day ahead, and happy trading.